Welcome back to the deep dive. It feels like whenever we talk about blockchain, we're almost forced to talk about the price of Bitcoin
Right.
or some JPEG of a monkey selling for millions of dollars.
Monkey JPEGs, yeah. It always comes back to that.
It just feels like we're discussing a casino, right?
Yeah.
Not a technology.
Casino, exactly.
Yeah.
That's a perfect way to put it. It's the nature of the hype cycle. It's loud, chaotic, and yeah, usually focused on the wrong things.
Exactly. But today, we are looking at something a bit different. I've got a stack of reports on my desk, one specifically from this month, February 2026, and it claims that casino phase is, well, effectively over.
Mm-hmm.
We're looking at a country that has decided to stop just testing this stuff and has actually started, ripping out the pipes of their national economy to replace them with blockchain.
It is a massive pivot. We are talking about the United Arab Emirates. And I think the phrase you need to keep in mind for this deep dive is infrastructure utility.
Infrastructure utility. Okay, that sounds, I'm going to be honest, incredibly boring.
That's the point. It should be boring. Real utility is invisible.
Right.
It means the tech has just vanished into the background. It's not about speculation anymore. It's about how you prove who you are, how you buy a house, or how you trade a barrel of oil.
So to walk us through this, we're unpacking a report. It's titled The UAE Blockchain Ecosystem, where technology, policy, and capital converge.
And it comes from Binance and the Abu Dhabi Blockchain Center. It paints a really fascinating picture.
Also,
It details how this federation of 7 different emirates has essentially built a regulatory layer cake to attract global capital.
a layer cake. Okay, we will definitely get to the layer cake, which I'm assuming isn't made of chocolate.
Sadly, no.
But first, let's just ground ourselves.
Yeah.
It's February 2026. What's the context? Because I admit I still have this mental model of the UAE as just, that place with the oil.
That's the old model. And yeah, they have oil, but look at the numbers in the report. You have a population of about 11 million people, and here's the kicker. Almost 90% of them are expatriates.
90%.
Yeah.
So it's basically a global transit lounge that functions as a country.
In a way, yeah. It's this melting pot of talent and capital. And economically, they've really pivoted. Non-oil sectors now drive over 70% of their activity.
So they saw the writing on the wall.
Years ago, they knew the oil wouldn't last forever, so they started building a digital economy to replace the petroeconomy.
So this is the new plumbing for a post-oil world. The report calls this tokenizing the world. Now, I want to push back on this a bit. We've heard tokenization as a buzzword for, 5 years now?
At least.
Why does it actually matter? Is it just a fancy way of saying database?
It's a valid skepticism, but it matters because of one key economic concept: liquidity. The report makes a really strong case that blockchain transforms heavy, slow assets into light, fast assets.
Heavy versus light. Okay, break that down for me.
Okay, take real estate. It is probably the heaviest asset class in the world. If you want to sell a luxury apartment in Dubai, think about all the friction. It takes months. You need brokers, lawyers, mountains of paperwork, and you need to find one specific buyer with millions of dollars. That's illiquid.
Right. I can't exactly sell my kitchen to buy groceries if I'm short on cash.
Exactly. But in the UAE's new model, and this is what they're building right now, you tokenize that apartment, you split the ownership into, say, 10,000 digital units.
Okay.
And suddenly, a retail investor in Tokyo can buy $500 worth of that apartment. A hedge fund in Singapore buys $50 million worth.
So it's basically the stock market, but for a specific physical building.
Precisely. But here's the killer feature: settlement. In the old world, closing a property deal takes, 30 to 60 days?
If you're lucky.
On these blockchain rails, it settles in seconds. 24/7, you've turned a building into something as easy to trade as sending an email.
That is the aha moment. It's not about the crypto coin. It's about the velocity of the money itself.
And it's not just buildings. This is where the UAE's history as a trading hub comes in. They trade gold, diamonds, oil.
Right.
And the report highlights how this just cleans up supply chains.
How so? Because supply chains are notoriously messy.
Well, think about diamonds. It's an industry that's been plagued by fraud, blood diamonds, all these questions about sourcing. A jewelry manufacturer in India can now just look at a blockchain ledger and instantly verify the source of a diamond from Dubai. It's immutable.
So you don't need a person with a clipboard walking around a warehouse checking if the inventory is even real.
You remove the trust tax. You don't need to trust the other guy. You just trust the ledger. Or take a refinery. They can tokenize their crude oil inventory to get a loan against it instantly.
Why?
Because the bank can verify the asset exists on the chain and hasn't been promised to 5 other people.
That's efficiency. But speaking of efficiency, or the lack of it, let's talk bureaucracy. The report mentioned something called UAE Pass.
This is one of my favorite examples of that infrastructure utility idea.
I saw the stat in here. 2.5 billion authentications. That's massive.
It is, and it solves a problem we have all faced. Imagine you're applying for a job in a new country. You need your university degree.
No, it's a nightmare.
Right. You have to call your college, pay a fee, wait for the mail, get it stamped by a notary, get it stamped by an embassy. It takes weeks. It's a tax on your time and your sanity.
It really is.
With the UAE system, your degree is a verifiable credential on the blockchain. You share a cryptographic key with your employer, and they know instantly with 100% certainty that you have that degree.
No phone calls, no stamps, no fake degrees.
None of it.
Okay, that sounds like a utopia of efficiency.
Yeah.
Well, let's look at the machinery behind it. You mentioned the regulatory layer cake earlier. This part of the report, honestly, it made my head spin a little bit. You've got 7 emirates, federal laws, local laws. Who's actually in charge here?
It is complex, but the report argues that the complexity is actually a feature, not a bug. They've created this sort of decentralized network of specialized regulators. You have to look at it in layers to understand it.
All right, guide me through the layers. Let's start with the big institutional money, the serious suits.
If you're a massive global bank, think JP Morgan or HSBC, you go to Abu Dhabi, specifically the ADGM, the Abu Dhabi Global Market.
Okay, why Abu Dhabi? Why not Dubai?
Because the ADGM operates under English common law.
Wait, pause there. An Arab emirate operating under English law. That seems counterintuitive.
It's actually brilliant strategy. International investors, they get nervous about local civil law courts in the Middle East. They don't know the precedents. They don't know how a judge might rule.
Right. It's an unknown.
But everyone in high finance knows English common law. It is the operating system of global banking.
So by using that framework, Abu Dhabi is basically telling the big banks, you are safe here. The rules are exactly what you expect them to be.
Precisely. It creates predictability. They are the adults in the room. They actually issued crypto regulations way back in 2018. They focus on capital requirements, strict supervision. If you want to hold billions in crypto, you want the safety of the ADGM.
Okay, so Abu Dhabi is this serious, risk-averse banker. What about Dubai?
Dubai is the commercial hub, the hustler.
Mm-hmm.
And they did something historic in 2022. They created VARA, the Virtual Assets Regulatory Authority.
And this is a standalone regulator.
Yes. And think about that. In the U.S., you've got the SEC trying to regulate crypto with laws from the 1930s meant for, like, orange groves. It's messy.
Yeah.
VIR is different. It only does virtual assets. That's their entire mandate.
So you aren't explaining what a blockchain is to the regulator. They probably know more than you do.
That's the benefit. They regulate everything in Dubai mainland and the free zones. But, and here's where the layer cake gets specific, VARA regulates everything except the DIFC.
The DIFC. I thought we were done with acronyms.
Not quite. The DIFC is the Dubai International Financial Center. It's a financial free zone, physically located inside Dubai, but legally it's like a separate country. It has its own regulator, the DFSA.
So you have Dubai regulated by VAR, and then a little pocket universe inside Dubai with its own set of rules.
Correct. And the DIFC is very specific. They explicitly recognized Bitcoin, Ether, and Litecoin very early on. They treat them almost like traditional financial instruments.
So who goes where?
Well, if you're an investment fund, you might prefer the DIFC. If you're a crypto exchange serving retail customers, you go to VO.
Okay, so we have the institutional anchor in Abu Dhabi, the crypto specialist in Dubai with VR, and this investment zone, the DAOs. But then I saw something in the report about Ras Al Khaimah and DAOs.
This is maybe the most futuristic part of the whole framework. Ras Al Khaimah, or RAK, launched the RAKAO regime in 2023.
And just for anyone who might not be deep in the weeds, explain what a DAO is.
A DAO is a decentralized autonomous organization. So imagine a company with no CEO, no physical office, no board of directors. It's run entirely by code, by smart contracts, and decisions are voted on by people who hold its tokens.
It sounds cool in theory, but it also sounds like a legal nightmare. If the code breaks the law, who do you sue? If the DAO wants to rent an office, who signs the lease? A piece of software can't hold a pen.
That is exactly the problem that RAK DAO solved. They granted DAOs legal personhood.
Legal personhood for code.
Yes, it bridges that gap between the digital world and the physical world. Under this law, the DAO is a legal entity. It can own assets, sign contracts, appear in court. It allows these futuristic code-based organizations to actually function in the real world.
That is wild. So you could have a company run by an algorithm that legally owns a building in Ras Al Khaimah.
That's the direction they're heading. And it just shows how specialized the UAE has become. They have a specific jurisdiction for every single type of crypto business.
It wasn't always this organized, though, right? The report talks about an evolution. I'm guessing there was a messy phase before all the suits and lawyers showed up.
Oh, absolutely. We can break it down into 3 phases. Phase 1, from about 2017 to 2020, was the Wild West.
Let me guess. Lots of scams, lots of vaporware.
Well, the report calls it fragmented autonomy. The free zones wanted business, so they just started issuing commercial licenses for crypto. You could get a license to be a crypto business, but there was no financial regulator actually watching what you did with the money.
So you had a framed certificate on the wall saying you're a business, but nobody checking if you were actually solvent.
Basically, it was great for innovation. A lot of startups launched because it was so easy, but it was terrible for investor protection. If things went south, you were on your own.
Classic early crypto days. Move fast, break things, and hope you don't lose the private keys.
Exactly. But then came phase 2, regulated commercialization, from 2021 to 2023. The federal government stepped in and effectively said, okay, the party's over, we need rules.
The adult entered the room.
They passed Cabinet Resolution number 111. It was a line in the sand. It said you cannot operate in the UAE without a license from the federal authority or a proper local regulator like VAR. No more hiding in the gray areas.
And that's when the big names showed up.
That's when you saw Binance, OKX, Crypto.com all start getting proper licenses. They traded the freedom of the Wild West for the legitimacy of regulation.
Which brings us to today, 2026, Phase 3, the utility phase.
Yeah, it's about volume. The report notes that domestic payment systems processed over 20 trillion dirhams in the first 10 months of 2025 alone.
20 trillion, that is a staggering number.
It is, and a huge chunk of that is remittances.
Sending money home.
Remember, 90% expats.
Yeah.
The UAE is the 3rd largest source of outbound remittances in the world. People sending money to families in India, the Philippines, Egypt.
Right.
Traditionally, using something like Western Union or banks, you lose a big chunk to fees and it takes days to arrive.
The poverty tax costs money to move money.
Blockchain brings that cost down to pennies and makes it instant. This isn't about speculating on a token price. This is about a construction worker in Dubai sending his full wages home to his family instantly. That is utility.
So we know the what and the how,
There.
but let's zoom out to the why. Why the UAE? Why are they winning this race? Why isn't it Singapore or London or New York?
The report identifies a few strategic pillars. The first one is simple geography. They call it the time zone bridge.
I like that phrase. But isn't crypto 247? Why does a time zone matter if the blockchain never sleeps?
The tech is 247, but the people managing the liquidity are not. Humans need to sleep. The UAE is perfectly positioned. They can catch the end of the Asian trading day in Shanghai and Tokyo, trade through their own day, and then hand off to London and New York as those markets wake up.
They're the layover for global capital, the baton pass.
Exactly. They ensure the liquidity never stops moving. And speaking of capital, that's the second pillar, the sovereign wealth funds. We are talking about $2.5 trillion in assets.
That is a lot of dry powder.
And unlike venture capitalists who need a 10x return in 3 years, sovereign wealth is patient capital. They're blending this massive stability with the volatility of crypto. It dampens the risk for the whole ecosystem.
And what about talent? I keep hearing about the golden visa. Is that just a marketing gimmick?
It's a very effective one. If you're a developer or a founder, the UAE offers you a 10-year residency and, crucially, 0 personal income tax.
That's a hard offer to turn down if you're sitting in London or California paying 50% in taxes and dealing with a crazy high cost of living.
Plus, English is the business language. There is no barrier to entry. They have effectively built a brain drain magnet for the rest of the world.
It seems like they're playing a very long game. The report mentions in National Vision Plan, We the UAE 2031.
They want to triple their GDP to 3 trillion dirhams. They view blockchain and AI not just as cool tech, but as national imperatives. They're betting the entire future of the country on being the hub for these technologies.
So let's try to synthesize this. We've gone from a world where buying a coffee with Bitcoin was a novelty to a country that is building its land registry, its identity systems, and its financial plumbing on these rails.
I think the key word is operationalization. The UAE isn't just writing laws for the sake of it. They're betting that by creating a safe, boring, regulated environment, they become the global clearinghouse.
It's ironic, isn't it? Crypto was born out of this desire for decentralization, for getting away from government control. But here, the government is the biggest cheerleader.
That is the unique paradox of the UAE model. They're using centralized regulation to enable decentralized technology. They realized you can't have mass adoption without rules.
Which brings us to a final thought for you to consider. We talked about geography, the time zone bridge, the physical ports in Dubai, the location.
But here's the provocation I want to leave you with. If assets, real estate, oil, gold become fully tokenized and liquid, and the infrastructure is entirely digital, does the physical location of the market even matter anymore?
That is the question. If I can trade a Dubai apartment from a laptop in Tokyo as easily as sending an email, why do I need to be in Dubai?
Exactly. The UAE is betting that because location matters less technically, it will matter more legally. They're betting that in a borderless digital world, capital will park itself where the laws are clearest and the regulator is the friendliest.
So the geography of the future isn't about where the land is, but where the server and the regulator resides.
Precisely. They're banking on trust being the ultimate commodity.
That is a lot to chew on. Whether you're in real estate, logistics, or just trying to send money overseas without getting gouged by fees, programmable money is quietly rewriting the rules of the game.
It certainly is.
We'll leave it there for today. Thanks for diving deep with us, and we'll catch you on the next one.